What is going on, investors? Hopefully you guys had a great day out there. Time to talk about Teladoc Health, ticker symbol TDOC or TDOC, like I like to say. Now, this company just reported their Q2 financials, and it is indicating a slowdown, which we actually talked about here on the channel on the last video that we did a few months ago. We will get into the numbers. I'll show you the slowdown from a percentage basis. We'll get into the assets, the liabilities. We'll get into the profits and the big time losses that we're seeing over this company and why I have not been recommending this stock. Now, from a technical perspective, we were up over $300 on this one. Our last video we published was April 28th. It's right here, April 28th. I had a fair amount of views on this one, but man, I was answering comments on this video as late as like last week. People saying, hey, I didn't know what I was talking about. This stock was at about $175. I didn't like the stock. It traded all the way down to 130. Now it came all the way back to 175, but now we are all the way back down in the after hours trade, back down to about $138 per share. I tell you what, this might be creating a buying opportunity for TDOC from a technical perspective. Okay, from a fundamental perspective, we'll get into that here in a second. Now, one thing that is propping this stock up and is kind of holding it up, in my opinion, keeping it an elevated valuation, and it hasn't sold off even more, is look, you got ARK funds over here at a 5.6% rating. This is on their ARK, their flagship fund, the ARK K, and then you got the ARK G, which is like the genomic revolution. This stock is actually the highest weighted stock in that entire portfolio at 6.82%. If Cathie Wood changes her minds on TDOC, whoo, that would slide the stock even further than I think you've seen over the last few months. Now, the Q2 financials do indicate a little bit of a slowdown. We're seeing US visit fee access gained like 1%. It was basically flat year over year versus growth of 20 and 15% in previous periods. So you're definitely seeing a slowdown in terms of visits. The other thing that you're seeing is total visits for 2021 is estimated between 13.5 and 14 million visits, implying 30% growth. And you might say 30% growth is great. Well, I just did a video on Google, I just did a video on Microsoft, and I just did a video on Apple, and they're all growing at this 29% clip, if not faster. And they have way more money and way more profits and dividends and buybacks and those types of things. When we get over to the financials over at TDOC, you don't got any of that. And not only that, you grew 156% in 2020, 156% in 2020. And a lot of people made comments on my previous video that I got to factor in the Livongo merger. We did a video last August on the Livongo merger and how I don't understand that deal and how that will impact the financials. Well, guys, it doesn't look like the market cares about the Livongo deal since this stock has been kind of in free fall for several months now. The other thing to factor in is Teledoc bought Livongo when it had 156% growth last year. If you buy something at the top of the growth rate, you are going to overpay for that. And I think we'll find over time that Teledoc and Livongo merger was not great from a financial perspective, okay? Because it's like buying a house in 2007. It was like buying stocks in 1999. Those types of things. The business basically fell off a cliff shortly after that. Here's the evidence of this U.S. paid membership. This is visits. It's basically quarter over quarter. We're up just 1% on this one. Not necessarily something I'd focus on too much. Look, you don't necessarily have to grow your business. You could raise prices. You can, create other services as well. The visits, while is an indicator of growth over at Teledoc, not necessarily the full story. So I'm not going to focus on that too much. They do lead their financials off with a balance sheet, and they do look relatively healthy. Forgive me if I refer to any of these numbers in billions. I just got off the heels of doing FANG, which almost all their numbers on their financials are in billions, so I might be in habits of saying that. But this cash and cash equivalent in the left-hand column was just 6 months after the right-hand column is right at $783 million. They got a ton of cash over at this company. They've got a lot in receivables as well. They've got a little bit on short-term investments. All things being considered, they got $1.1 billion worth of total current assets. The vast majority of that is actually cash. From a asset perspective, they're looking really good. As you would imagine, a company like this, while they do have some total liabilities, the current one's sitting at a 276. You've got some other ones sitting financing here, including some deferred taxes and a convertible note, which is a little bit different type of liability. All things being considered, this company is very, very financially healthy from a balance sheet perspective. But that is where things end, at least when we get to the statement of operations. This is revenue. This is profit. Here's our revenue. Our quarter ended here. Right-hand column over left-hand column is quarter over quarter on a yearly basis. The right two columns is quarter or year. 6 months over 6 months, half a year on a basis that sense. Now, revenue coming in, look at this growth, okay? And this is what's going to kick off press releases. This is what management is going to talk about on the call, is the fact that they went from $241 million all the way up to $503 million. Guys, that's greater than 100% growth on the revenue side. That is fantastic. And no one is going to sit here with a straight face and say they wouldn't want or don't appreciate 100% revenue growth. We're seeing a similar story over the last 6 months. Look, this company's doing a fantastic job at growing their revenues, but what they're also having a fantastic job of doing is growing all our expenses. Take a look at this. Our cost of revenues went from 90 up to 160, which you would expect, okay? You would expect if you grow your revenues by 100% or more, you would expect your cost of revenues to grow in a, not necessarily equally, but in a rather spectacular fashion. That's what we've seen. But take a look at this. Advertising and marketing went from 47 up to 103. We more than doubled our advertising and marketing. So let me tell you what, if I owned a small business, I don't care what it is, a restaurant, a small business, a coffee shop, whatever it is, if I doubled my advertising and marketing and my revenue didn't double as well, I'd probably question the effectiveness of that advertising and marketing. So the company doubled their advertising and marketing and they doubled their revenue. That can not be sustainable, especially when you factor in, take a look at sales. 3x'd, more than 3x, from $18.7 million up to $64 million. Technology and development nearly quadrupled from 23 million up to 80 million. So yes, we doubled our revenue, and that is great. And that's all the bull investors and the management is going to stuff down your throat, is that we doubled our revenues. But hello, we doubled our advertising and marketing, over tripled our sales number. We nearly quadrupled our technology and development, acquisition, integration, and transformation costs. This probably has to do with the Livongo merger as well. So yeah, I didn't factor those in the financials. Those 11x'd over, or really 10x'd over the last quarter on a quarter over quarter basis. Still not good. Here's general administrative, probably the leakiest of all the expenses. Like the one you hate to see go up the most, because it's not tied to R&D. It's not tied to sales. It is tied to just general and administrative. Yeah, you guessed it. That pretty much doubled as well. And you have depreciation and amortization on here, which you can add back if you want to. That's probably why they include that on here. But that's sitting at $51 million. You've got total expenses going from $248 million all the way up, more than a double, to $582. So yes, we doubled our revenue over at Teledoc over the last quarter, but we more than doubled our expenses to gain that revenue. So if your kids set up a lemonade stand in front of your house and one weekend they lost money and the next weekend they spent twice as much on the lemonade and the employees and marketing, and they still lost more money the next week, you'd probably have to sit your kids down and explain to them they might not be running a great business. And that's basically what we're seeing here with Teledoc. You see, for the 6 month, it all holds true as well. Okay. Our cost more than doubled. They went from $450 million, more than doubled that, up to $1.1 billion in total cost. Again, that's on revenue of $956 million. You had total cost of $1.1 billion. So you guessed it. When you come down to operating income, or in this case, loss from operations, you're sitting 10 times, more than 10 times the loss than you did last year. You lost $7 million. You were at a turning point, some people might have said, from a profitability perspective, and that completely got wiped away, because now you 10x'd your net loss at nearly $79 million of losses in a quarter. And we see really over the last 6 months, it's the same thing. They're on like an $80 million run rate in terms of losing money every quarter, because you're at 160 in the previous period. You were at $28 million. Now, could it get worse if you're a holder of Teledoc shares? And spoiler alert, yes, it does, because as bad as these numbers are, and we could flow down to earnings per share, net loss, those types of things. I don't typically focus on that because you have loss of extinguishment on debt, you have interest expense, not that these things aren't important, paying taxes, those types of things. But I like to focus on how well the business is running, because all these other things, taxes, debt, that all has a way of solving itself if you're making money, and this company is not. And now, like I said, could it get worse? You doubled your revenue, but you 10x'd your net loss. It gets worse because take a look at the weighted number of shares outstanding, 76 million in the previous period. You were one of 76 million. Now you're one. They basically doubled the amount of shares outstanding to 156 million. So you got diluted by more than 50%. You, Cathie Wood, and anyone holding this stock has absolutely got obliterated by dilution. Let's move on to cash flows. They actually paint a pretty nice story. And why is that? We pull down this net loss number. We got our 6 months ended here. Pull down this $333 million net loss. Hello. We were at $55 million. So it's just accelerating, but you get to add back in depreciation, which I'm maybe not necessarily argue with, but stock-based compensation. Take a look. You get to add back $170 million for this company to 10x their loss from operations. They like quintupled their stock-based compensation. It went from $40 million up to $170 million. You get to add that back in. You get to add back in deferred income taxes. You get to add back in some interest, loss on extinguishment of debt. That means cash flows provided by operating activities, $134 million positive. But keep in mind, $169 million of stock-based compensation if you did not pay the employees at Teladoc in stock. Do you think they would work there? Probably not, unless you paid them in Bitcoin or cash or real estate or something else that goes up or is supposed to go up like stock sometimes does. Now, it has not been happening over at Teledoc. All things being considered with the cash flow statement, that's a little flawed on a company like this. I would focus primarily on this loss from operations, the fact that it went up tremendously, and that is because our total expenses went up as fast as our revenue growth. And so our expenses are growing as fast as the revenue growth, and the growth is looking like it's starting to really maybe plateau, if not fall off a cliff. That is having investors seriously worried about the stock, and they've really seriously been worried about this since the beginning of the year. The stock was at $300 per share. Again, came down here to 175. I posted a video, said I posted videos all along here, and from a technical perspective, it might be saying different things. Now, I just absolutely destroyed this company as much as I possibly could from these financials, because these are an absolute complete disaster. But here's the beauty of the stock market and why we look at fundamentals and technicals, because they don't always agree. From a technical perspective, we're $8 away from an area where I think you could legitimately, if you feel like it, buy this stock, because it was a bouncing point here. Now, it would not necessarily the hardest resistance point or the area of support. We have some candles back here where it kind of floats into, not necessarily an area where I'd expect a lot of support, actually a little bit higher about where the stock is right here. It acted as some support here, was kind of support resistance here, was support here, and we broke through that. That's why I'm looking lower on this one and anticipating this one probably coming down to this 130 range. Look, if you own Teledoc at a higher price and you want to average into that, first I'd ask yourself, why would you want to do that? Okay, it's like your kids have lost money quarter over quarter every weekend for a year selling lemonade, and they're coming in and saying, hey, daddy, we need more money. At some point, you got to sit down and have a realistic conversation. Is this company, is this business worth investing in at the current time? They're doubling the dilution. They are losing lots of money. It doesn't look like, in my opinion, that is going to reverse. And not only that, our revenue growth, while it's spectacular right now, doesn't appear that it will continue that type of growth in the future. This one likely will come down here, in my opinion, down into the 130, low 130 range. Can you buy it at that point, expecting some kind of bounce? Sure, I'd have a really tight stop loss if I bought bought this stock at 130. I would come down here to 127, 125, because if you get lower than 130 on this stock, it's just like when you broke these technical levels up here at 230 and 250 and 211. You know, you start breaking this and there's not a lot of support for this stock. Okay. It goes back down into levels that it has not seen in several years, probably below $100 per share on this one. So from a technical level, I could see we could come down here to the 130-ish range, give or take a couple bucks, and it could bounce. Okay. You're really, from a bullish perspective, I would not be bullish on this stock. And in my opinion, this sounds really weird. Maybe if you haven't been investing very long in the stock market, I wouldn't buy this stock. In fact, unless it got over 178, then you've broken technically the overhead resistance that's been created twice here at 174 or so on this stock. I'd want to break above that. You break above that, and it brings in all these candles right here from about 170, 180 on this stock all the way back up to 300. So if this stock can form a bottom here, and maybe that's what we're doing. We fell off a cliff. We're still falling. People are still digesting these numbers. We consolidate down here between 120 and say 150, 170 on this one. Then you break above 170 and it can be a rally mode. So that's what you're hoping for with Teledoc. They've got to turn this around at some point from a financial perspective, because they've run out of rope for the most part with investors outside of someone like Cathie Wood. And if Cathie Wood digests these numbers and starts dumping TDOC, I tell you what, you got to look out below. I would probably cut and run if Cathie Wood cuts out of this stock, because that would create a ton of negative news. And in my opinion, could create an even better buying opportunity to get Cathie Wood out of this one, kind of propping it up from a number of different ways. Well, look, this thing would sell off and you might get a nice attractive price down there. So we'll see what happens with TDOC, but that wraps it up on today's video. If you agree or disagree, feel free to leave me a comment down below. I try to read as many as I can. I try to respond to as many as I can as well. Hopefully you had a great day out there. Good luck with your investments.